I do think so. I think that the sentiment on gold has gotten to almost equal bearishness versus how bullish it was when we were trading north of 5,000. I mean, I used to do videos and people would attack me for saying gold was going to pull back. And now vice versa. I'm seeing when I do a video on gold and I talk about the cycle here and the bigger cycle that we're in, how we're going to eventually break out and make new all-time highs. People are telling me gold's going back to 1,800. And so it's the inverse of what we saw at the highs, which actually then creates that bullish catalyst for the offsides trade to kind of push gold back higher. I wouldn't be surprised if silver still has more downside. Now, you might say, well, if can gold break out without silver? And the answer is it can. It's generally unlikely, but it could break out slightly. And the key why silver could be an underperformer is imagine all of a sudden we get a slowdown in CapEx for data centers. We know that a lot of silver and copper is being used there. Or if the global or domestic economy slows down, that industrial side of silver could mean that silver does underperform in the near term if we get that economic slowdown.
Silver remains under short-term selling pressure, suggesting that prices could fall further before the next major rally begins. According to the technical charts, strong resistance is keeping silver from moving higher after it broke below an important support level. As a result, the metal could decline toward $50 or even revisit the $40 level before finding a solid bottom and starting a new upward trend. Meanwhile, the broader stock market is also approaching a critical moment. The S&P 500 is testing a major long-term support line, and if it closes below this level, it could trigger a larger market correction with the index potentially falling towards 7,000. At the same time, rising bond yields and widening credit spreads continue to increase concerns about growing debt risks. If industrial demand weakens, silver could lag behind gold in the short term, as ongoing inflation and central bank policies continue to create uncertainty across global markets.
I wouldn't be surprised if silver still has more downside. Now, you might say, well, if can gold break out without silver? And the answer is it can. It's generally unlikely, but it could break out slightly. And the key why silver could be an underperformer is imagine all of a sudden we get a slowdown in CapEx for data centers. We know that a lot of silver and copper is being used there. Or if the global or domestic economy slows down, that industrial side of silver could mean that silver does underperform in the near term if we get that economic slowdown. Yeah, I think for the most part, it's exaggerating it just because silver tends to move in multiples of gold, or at least 2x gold. I am not loving this chart yet on silver. I still think there's downside. You can see, again, you had this beautiful base right here where we just kept on hammering on it as support, and then finally we broke lower. And then notice how this trend line was support, but once you break down, it becomes resistance. And we went up into it and price got rejected. And now we're just kind of floating sideways. There's no real good nature to this. So on silver, I need to see us recapture this $65 to $64 level and break out above this trend line, much like I need to see gold break out before I can get heavily bullish on this. And I actually still think there's a good chance we touch $50 and retrace to the 2011 peak before silver really has its next major run. I would choose gold for the longer term. And I say that mainly just because it's safer, right? If you're thinking about someone who has a longer term horizon that doesn't want to be scared out of a trade. I mean, for all we know, silver could come back to $45 or $40 per ounce. I think the gold trade is the one because it's the one that's most directly tied to what we know, which is the U.S. debt is at 40 trillion almost. We have that kind of the printing of the global fiat continuing to rise at least 7% a year. And so you're playing directly the play that the governments and central banks are going to never really be able to rein that in because global debt is just so high, right? So we just can't go back to that Volcker style, which means long story short, you get more money printing. So I think gold's the safe kind of play. Is it going to be the sexiest? Is it going to go the most? It may not, but at least you sleep better at night. So I think it's the concentration in the semis. So much leverage has been put in there, and it's still so levered. And we're seeing this in names like Oracle, right, where it's a combination of the debt and how much they're taking on and whether or not they're going to get these kind of results that they hope to get. And I still think earnings are going to be generally good. But again, if margins just start to come down a little bit, markets always price in 6 to 12 months out, and that's going to be very problematic. And by the way, I'm just noticing the S&P here has rolled over. We're almost back to the lows of the day. I'm not sure if the market heard something from Kevin Warsh or what, but wow, look at the S&P come right back down here. And again, that's just something we'll have to kind of look into, but really remarkable decline here on the S&P back down. By the way, I just want to show you this S&P chart. This is a line in the sand that's going to determine if we have a bigger correction or just a pullback. Here's a trend line going back to the highs in 2021's bull market, connected through this high here in 2025. And look at how the market behaved. It broke out, it retested, bounced, retested, bounced. Now it's back again to this trend line. And the reason I'm bringing this up is that if we break this line and we have a daily close below, that would be a warning sign to me that the S&P here could head down to the highs from early this year, which would be all the way back to about 7,000 on the S&P. So really big level here, right around 73.30. Watch that on a daily closing basis on the S&P. We stay above it. The bull market's intact here in the near term. We break below it, we're likely going to 7,000.
Yeah.
So I think the question is going to be, we're going to get a bounce at some point, whether it's tonight or in the next week, the Kospi will bounce. The question that I'll be watching for is how big of a bounce? Does it go and take out the highs? Okay, well, the bull market structure is intact. If it bounces, let's say 50% of the way and then comes down and takes out those recent lows that we just made in the overnight, that would be very concerning to me overall, as again, it's starting to make the lower low and lower high structure that is a bear market, not a bull market.
Yeah.
That's what I'm getting from this right now, is it's saying that the longer term, and this is duration wise, is that there are still issues. There's this inherent inflation, and as much as the tough talk from Kevin Warsh today was in terms of he said we're going to get this under control. The market right now is telling me they're not buying it. They're not buying it. And again, I go back, unfortunately, to President Trump, when he appointed Kevin Warsh, he said, or before he appointed him, he said, I will not appoint someone who's going to raise rates. And so the market might be saying, Kevin's talking about, other methods of doing this. He's talking a tough game, but is he really going to follow through? And maybe the long end of the yield curve here is telling us something. I think so. I think those credit spreads are really starting to raise alarm bells. And this is where, as an investor, you have to start saying, okay, Kevin Warsh was talking a solid game here. But if there starts to be a credit crisis, is the Fed really going to say, hey, inflation's still at 3.5%, we're not going to lower rates? Or are they going to come to the rescue and start printing money again? And this is really something that is, as I'm seeing the market react here in real time, is getting my attention that something bigger could be in the works here. And if we see this market roll over, you better believe that there could be some surprise debt issues that pop up very, very quickly. Still trading inside the topping structure. You can see, again, this down-sloping trend line from the $120 high that hit in March all through these highs, and that was my short signal right there. I already got out of the short. It was just a really quick trade. But at this point, unless we break out above this trend line, it's just a kind of a sit on the sidelines, and let's see where this goes. These two lines will continue to converge over time. Inevitably, oil will have to break one way. And that's going to be something that I will watch and see if I can actually, look to capitalize when we get either a major breakdown or breakout. But right now, oil's getting a bounce. We seem to see this cycle going on and on where, a couple days there's no fighting and the oil drops and there's a couple positive words about negotiations. And then on the other side, then all of a sudden you have the missiles flying again. And I think the market is just trying to wait this out, hoping that as the midterms approach, things will calm down more and more with Iran.
Yeah.
Financial markets are entering a period of growing uncertainty as rising debt, persistent inflation, and expanding money supply continue to reshape the global economy. While many investors remain focused on short-term market swings, precious metals are quietly forming technical patterns that could signal much larger moves ahead. Veteran market trader and technical analyst Gareth Soloway believes gold is approaching a critical turning point after its recent pullback. Looking further ahead, Soloway argues that the long-term trend remains firmly bullish, driven by central bank policy policies, excessive government borrowing, and the ongoing erosion of fiat currencies. If these macroeconomic forces continue, he believes gold could eventually reach an extraordinary target of $13,000 per ounce during the next major market cycle. In today's video, we'll break down Gareth Soloway's latest outlook for gold, the key price levels he's watching, and what his analysis could mean for investors in the years ahead.
I think, again, we have to respect the trend line that has held up since the highs on gold until price really clears that hurdle and holds above it. I'm looking at it a little skeptical. Now, you guys know that overall I've been bearish on gold, but I'm now at a point, and once we got below 4,000, where there's a little bit of downside potential, but we're close to the end of this down cycle before I do think the price on gold starts to move up. And it's got some upside potential over the next few years. I mean, great move on gold, but look at how this what we call a wedge pattern in technical analysis has behaved. You take your all-time high, it hits again here and here all the way down. And recently, we've been hugging just below this major trend line. And this trend line for me is essentially the line that I'm watching to know when there's a breakout in gold. And notice how today we rallied up into that line, and so far gold has pulled back off of it. And so as a technician, simply put, just like you said, 4,100, we need to clear that hurdle on a daily closing basis. If that happens, you have a short-term breakout. I don't, by the way, think gold's going to zoom right to 5,600 again. It's going to take some time. It's going to take some digestion, but that's the first step in potentially seeing gold start to recover and move back to its all-time highs.
Yeah.
You know, it's going to be tough for gold, right?
Yeah.
And part of it, too, is that oil is a major component here. Oil is pushing up the 10-year yield because it's raising inflation expectations. And so we've seen recently this run up on oil back into the $80+ range. You want to see oil come in. That will relax the potential of these rate hikes. We also want to see what the jobs data is coming up for this past month here as we're coming to the end of the month. And we want to look to see, is the jobs market as strong as people think it is? And if it starts to weaken a little bit, the dollar will fall very quickly, and that's one more positive for the gold price. The first thing we want to see is that close above 4,100. Once we get that, you don't want to see the next day it come right back below 4,100. So there's something called the confirmation signal, where you get a close above a key level, and then you need to see a secondary close above that level and a little bit higher than the previous day's high. What that tells me is there's real teeth to the move. It wasn't just a whipsaw like you're talking about here, where we're seeing this kind of move up on the back of Kevin Warsh's statement and the Federal Reserve statement, where we can see these type of whippiness, but where do things settle? Where does the dust settle? And that gives us the signal there. And really the other thing too is the dollar's been hovering here. And if we go to the charts, let me show you guys this. This is interesting. So the dollar has been hovering right up in this upper zone. And we can see again, going back a ways, even back over here in 2025, we came up to this high and it got rejected. And here we are, we came up, rejected, and here we are again getting rejected. You want to see the dollar continue to fall here. If the dollar continues to back off resistance, now we're in a state of potential upside in gold. Lastly, just watch this trend line here. If we pull back to just under 100 on the DXY, and if we break that, gold's got significant upside in the near term and midterm. It's based on a calculator that I created, and essentially the calculator takes into effect multiple factors. One is how fast is the money supply? And again, we're not talking US money supply, global money supply running. And right now it's running at 7%. So if you just assume over the next 5 years at 7.5% or greater, that starts to push the cycle of gold. And what we looked at here is when you have the first cycle between 1980, the second peak was 2011. So we're talking, 31 years there of interim cycle. And then the next cycle, it was just 2011 to this 2026 high. And so what we're seeing is because of the increased US deficit and global debt, the increased money supply, real rates, and inflation, all of these are creating shorter cycles in gold and then more dramatic moves to the upside. And essentially, it's a calculator that calculates the probabilities of the next move. And again, it's telling me that 13,000 is going to be the next peak, but again, between 2029 and 2031. Now, like you said, people are going to hear that and say, oh, I don't want to wait that long. But keep in mind, that doesn't mean we're not going to make new all-time highs before that. It just means the next cycle peak, the
Yeah.
one that, we dream about, that may just take a few years to come by. And it's really at shortest about 3 years out.
Gareth Soloway believes the next move in the market will provide an important clue about where stocks are headed. A strong rebound that pushes the S&P 500 above its recent highs would suggest the bull market is still healthy. However, if the bounce is weak and the index falls below its recent lows, it could confirm that a larger correction is beginning. He also warned that rising bond yields and widening credit spreads are signs that financial stress is increasing, and investors should pay close attention to these signals because they often appear before bigger market problems. Soloway also explained that the Federal Reserve could face a difficult decision if economic conditions continue to weaken. While officials say they are committed to fighting inflation, a growing debt or credit crisis could eventually force them to cut interest rates or inject more liquidity into the financial system. He also noted that oil remains stuck in a narrowing trading range, and he is waiting for a confirmed breakout or breakdown before taking a position. Overall, Soloway believes investors should stay patient, watch key technical levels, and be prepared for increased volatility across stocks, bonds, and commodities as the market searches for its next major direction.